The next bit is we're going to look into market structure. We're going to look into market structure. Now, market structure is basically the movement of price in the market, like how price moves in the market. Basically, that is what we mean by market structure. Now, there are two types. There are two types of market structure. We have trending market, and then we have two non-trending market. So these are the two. Wait. About that. Okay, so let me just take all these things out of it. So these are the two types of market that we have, and with trending market, under it we have a bullish market, and the next one is bearish market, or we can say downwards market, and this one you can say upwards market. And for the non-trending market is basically one which we either call it choppy or sideways or consolidating. Yeah. That is the type of okay. So yes, so for the type of markets that we have the trending market, which consists of the bullish or upward market, and then the bearish market, which or downward market, and then for the non-trending market, we have the choppy or sideways or consolidated. It's basically the same thing, but there are several names for it. People choose to call it sideways, some choose to call it choppy, some also consolidating. So if you hear any of these choppy, sideways, consolidating, it's more of the same thing. So now let's look at trending market and how the trending market is basically, let's take the bullish perspective. For a bullish market, now one thing in Forex is that price do not go in one direction all the way throughout like this. You don't have price doing this straight move. That doesn't happen in Forex. So what happens is that in an upward market or in a bullish market, price goes up a bit, and then at a point it chooses to come back a bit, goes up again, but this time surpassing where it reached the first time, comes back goes, comes back, goes. And this is what we call a bullish market or an upward market because it's going up. You can see that even though it goes and then comes back, it's going up. Now we have something that we call the nature of the market. And the nature is more like what happens when the market is trending. So this very first phase, we call it the impulse phase that is going up. And then we call this other phase coming down, we call it correction. So there's the impulse, correction, impulse, correction, impulse, correction, impulse, and then correction, and then it goes on and on. That is during an uptrend. So this is how the market trends when it's going up. And we'll look at an example of it in a few minutes. Now, the next one is the bearish market. And in the bearish market, too, price do not go all the way down like this. You wouldn't have that happening. It will always go in a trending way, just as we saw. So we have the impulse, correction, impulse, correction, impulse, correction. So, I'm sorry. Yeah. So this is how when the market is also bearish or is going downwards, this is how it looks like. It comes, I have an impulse, there's a correction, an impulse, a correction, an impulse, a correction, and an impulse. So that's when the market is bearish or going downwards. That's how it goes. So price usually do not go in a straight line. The direction goes in an impulse and then there's a bit of a correction. You can see it in a way like, let's say, someone who wants to run from, let's say, Accra to Kumasi. Let's take that as an example. Now, what a person does is initially he starts running to that towards that direction. He goes, he gets to a point he or she gets tired. Then he has to slow down or probably find somewhere to sit and relax for a bit. Then when he has enough energy, he goes again, get to a point, wants to rest, find somewhere to rest, relax, and then goes again until in that format until he gets to its destination. So that's how price usually acts. It doesn't move in a straight line, but it goes, comes back, relaxes a bit, goes in that form. So this is a trending market. It's either there's a direction to it. That's why we call it trending. There's a direction to it. So this one you can know that this is the direction, is going downwards. On the other side, you you also know that it's going upwards because it has a direction. Has a direction. So that is for the trending market. Now we'll look at the non-trending market, which is the choppy market. That one usually goes in one way. So that's why we call it either going sideways, choppy, or consolidating. It goes in um, a single direction. So for the choppy market, what it does is price goes to a point, comes back to where it left off, goes to that point, comes back, goes to that point, comes back, goes to that point, comes back. So that is for a choppy market. So you could see that price has two major points that what is happening? You see that price has two major points that is going in between. Yeah, it has two major points that is going in between, and this is what we call sideways market, choppy market, or consolidating. And we'll look at when we come to in terms of analyzing more further, would look at how we trade in the various scenarios. But usually, the best advice is that during this kind of market where it is choppy, we don't trade. This is more like a rule that traders use, and it helps. Even though there is a way to trade within this market, usually it's advisable to ignore and find a trending market to trade, or either wait for price to break out of it, like this one breaking out before you trade, because when it breaks out, it's usually going to form a trend, either going upwards or coming downwards. So you wait, once you identify these two zones that price is going through, you wait for it to either break out on the top or at the bottom and see if it trends. Once it's in a trending market, that's when we try to trade it. Usually, we don't trade in a choppy market. We concentrate more on the trending market, and that's where you can find opportunities to trade and make some profits. So that's for the shopping market. Now we can look for some examples on the charts itself. Look for some examples on the chart itself. Okay. Let me come to somewhere like the 4 hour. Let me go back. So over here, I want a clean one. So over here, we could see the price was in a trend this way, coming down. That is a you see that price was in a trend that is coming down, and that is a bearish trend or a downward trend. Now, if we are to mark the structure, you can see that price came down here, went up, came down, went up, came down, went up, came down, went up. So that's that. So that's the bearish impulse correction, and that's the bearish trend. So within this, let me highlight. Within this portion, you can decide to identify and trade within this portion, because this is a trending market and the trend is downwards. The trend is downwards. So we will also look at set it, or I can tell you right now that as a general rule of thumb, since we don't trade in a choppy market, since it's not advisable to trade in a choppy market, even though there are ways to trade it, which we will look at that later. Um, when the trend is down or the trend is bearish, we only look for sales in the market. Even though you can see that price went down, went up, went down, went up, and you can see that price going up means you could have bought and you could have made profit. Going up here, you could have bought. Going up here, you could have bought. Going up here, you could have bought. The general rule is to ignore all the buys within the downtrend and concentrate on the sales. The reason being that since the trend is down, you are likely to make some profits from that direction than going opposite to the direction. Usually, you'll be in losses if you try to go opposite to the direction. So if the trend is down, you only look to sell. So you only try to find selling opportunities when the trend is down. So that is that for the downtrend. We can also see an uptrend here. I think probably maybe I have to look for a more longer one. This pair usually has yeah. Even over here, we can see that this is an uptrend, but I want a more clear one. Okay, nice. I think we can use this. So we can see the price is going upwards in this direction. So that's an upward trend or a bullish trend. And we can see the price went up, came down, went up, came down, went up, came down, went up, came down, went up, down, up, down, and up. Oh, and we redo it. Went up, came down, up, down, up, down, and it just use the major ones. So yes, so this is for an uptrend. And one thing is that during the illustration, you realize it was more smoother. But in terms of price movement, you wouldn't have it smooth like how you do it, like it's going in equal measure like that. No, sometimes it's a bit um, sometimes it's a bit not like accurate, but you could still see the general picture or the general trend that price is going up. And so in this kind of trending market, we also only look for buys. So during an uptrend, when you are trading, you only look to buy, you don't look to sell. If there are any selling opportunities, just ignore it. Concentrate on the buys, make profits from there. So that is an example of that. Let me see if I can find another pair, and then we can look at it. Let me see. Let's look at Australian dollar and then the New Zealand dollar. Let's see. Yeah. So you could so on each time frame, you definitely have these trends. You can identify trends and I think we didn't look at the choppy one. Let me see if I can just identify a choppy market over here. Yeah, I think there's a choppy one. And that's not that, but then I think, yeah, we can look at it as the choppy market. Price goes up, comes down, goes up, comes down. So even though it's not uniquely like a, oh, even though it's not uniquely like a choppy market, we can still see that price was in between or going up and down within um, this range. And during here, even though there are ways you can trade, or you can at least reduce it to somewhere like here. Yeah. Even though there are ways to trade it during this phase of the market, you totally ignore it. Once you see that there's wait for it to break out, either at the top or at the bottom. Now over here you can see that it broke out, but then it came back in again. So you also have to monitor. Once it breaks out, you just don't start trading once it breaks out. You have to monitor to see if it will come back or it will actually stay out of it. So over here, we can see that it broke out here, came all the way down, and then it broke out down, and then you realize that it started forming a trend. So you could wait for it to actually identify that it's forming a trend, and then you can then start to trade or look for trades. Here you can see that this was more of going downwards, and then probably started being choppy a bit here as well. So you can just decide to draw a box when one is choppy, and then you wait for it to break out of it, and then you see that it went up. It took went on an upward trend a bit, and then the trend changed to a downward trend. Downward trend. So in terms of trading, if you are able to identify the trend of the market, that is more like 50% of the job done. Or I should say, okay, probably let me give it a bit about 40% of the job of trading done. So the first thing to do in terms of trading, and we'll go into that when we get into strategies and further analysis, is to identify the trend of the market. Once you're able to identify the trend, then you know that we are in this type of trend. So I'm looking to do only this kind of action. And if you follow those rules or these rules, you'd probably become profitable far more than anyone who tries to buy and sell irrespective of the market. So the first thing is to be able to identify the trend. So you can be practicing this